Hey guys, welcome back to the channel. In this video, I want to go over the recent pullback in the markets and potential stock market crash starting, and talk about potential recession that people are going crazy over on the internet currently. So I want to look at the S&P 500. We've been talking about this the past couple of weeks, how we're due for a pullback, we're due for a correction. You can call it a crash if you want, whatever. But just want to show you a couple things on the charts to kind of have you aware, I guess. Okay, so 53, 68, 57, that was the current support that we were looking at on the S&P 500 180-day 4-hour time frame, and we broke below that. Okay, so now, and a big red candle here, and it looks like we can potentially see some more downside all the way down to 51.8230, and if we break from there, 5,031.75. And as you know, earnings plays a big part in what's going on in the market. We had some missed earnings from some stocks or from some companies. We had mixed earnings yesterday from Amazon, which is getting kicked in the teeth, and so that plays in to a big factor of what's going on in the markets, because there's been basically several handfuls of stocks that have pretty much just been carrying the market the past few months. And if those things are getting kicked in the teeth, then obviously the whole market in general is going to be getting kicked in the teeth. And we could just kind of be getting started. However, I just want to kind of talk about why you really shouldn't worry if you're a longer term investor, and you just kind of should just kind of keep playing the course, because now you're going to get better buying opportunities on things that you are looking to hold longer term. Okay, like a Tesla, like an Nvidia, like an Amazon, which we're going to look at really quickly. We'll take a look at Amazon and show you exactly what's going on there. So as you see, this is after earnings. We got all the way to like 191 and some change, and now fell as low as 160. We're at 163.56 right now. Might find some support right here and start making our way back up. If we break below, we could see 150, possibly 139. But I think that would be most likely, probably your bottom would be around there, about 140 or so, or maybe even 150. So looking at Tesla, and Tesla 212, I think 200, anywhere from 200, maybe even 190 might be your bottom there. And then we're going to look at Nvidia. These are three that we've been talking about. We hit 100, it flashed all the way up to about 120, and now we're back at the $100 mark here. Almost undervalued, not quite there yet, which makes me think we could get into the 90s. And if we do, I'm going to come back in and buy some more there. As I mentioned, that I'm not fully in my full position yet on that longer term. So the more it drops, the more I buy. I'm just kind of nibbling until I can get the amount that I want, and then I'll hold for the longer term. Same with Tesla, Amazon. Tesla and Amazon, actually, if they fall, Amazon's still about 40, 50 bucks above, per share above my price that I bought in. So I'm not buying yet unless it hits 125 or below. Okay, if it hits 125 or below, I'm a buyer. Tesla, not so much yet. If it falls into the 100s, then, or anywhere close to 100, then I'm coming in and buying some more there. Nvidia, basically here, anywhere in this channel here, from 100 all the way down to 80. I'll probably come in and scoop some as long as it stays there. Okay, so one other thing to keep in mind, people are talking about the SOM rule indicator, which shows that we are going into or in a recession. And the SOM rule is basically named for the former Fed, is the name for the Fed economist who came up with it, Claudia SOM. She found that a recession is almost always already underway if the unemployment rate, which is based on a 3-month moving average, rises by a 0.5 percentage point from its low of the past year. And apparently that's happened. Okay, which means that we are entering, or already maybe in, a recession. And so just something to keep in mind there. So we could see, more downside of, obviously people are probably freaking out, and, the stock market is nothing more than an overreaction to the upside or overreaction to the downside. So it's important to kind of just stay the path and keep doing what you're doing. Unless you're like an active or swing trader, then obviously this factors into a lot of things for you. You want to make sure that you keep up with this type of news, because obviously the market can react very quickly. We'll take a look at the S&P 500, and this is on a 5-year chart. Okay, so this was March of 2020. Remember this? The huge downfall here, and we had a really nice run. And then this is about 2022 when everything started falling, and then we found a bottom eventually, and then people came in and said, you know what, I think these are some good prices to start buying at. Things kind of started changing, and they had a nice run to the upside. 2023, another pullback, and then another nice run to the upside, pullback, nice run to the upside. Okay, so you kind of see a pattern here. So I think we're at a pretty crucial point when we get to about 5,000. If we do get to 5,000, if we break below this here, the 49.6723, then you can potentially see a lot more downside. That might be a little bit more troubling, but I wouldn't freak out just yet. I think that if we fall to about 5,000 on the S&P 500, that you see some buying pressure and move back to the upside. However, it doesn't mean it's going to stay there, right? If we can't bust above that, we could be in for a nice little pullback here, which we've been talking about, and which is normal, though. Again, things don't just go straight up. If you see the S&P 500 all the time, all right, it never has just gone straight up, and this is a more of a longer term maximum chart. We are due for another correction. Okay, we're due for something to pull back. So I would think maybe even 4,500, somewhere in the fours, that we could go longer term before we start recovering, and then start making our way back up. So I wouldn't really freak out just yet. However, I wouldn't expect a rip to the upside and the volatility be done. I think we're just getting started. So, you know, again, based on your trading strategy, whatever you're looking to do, if you're a long-term investor, buying the dips, staying the course, keep on averaging down, keep on buying and everything. If you're a swing trader then, or a day trader, whatever it may be, then you're going to have to be a lot more active and keep an eye on the news and things of that nature of what's really going on in the market. So am I freaking out? No, I did expect this. Some positions in my down end, yes. But again, wasn't in it just for a couple of weeks. I'm in it for, years to come. And so I'm looking to average, get more shares in, hold for the longer term, and when things start looking on the up and up, and that's whenever you can reap the benefits. So, all right, guys, that's all I got for you in this one. Let me know your comments below. Other than that, we'll catch you in the next one.